Hello and welcome to our conversation on financial statement analysis. And in this session, we will examine the financial statements of Bectors Food Specialities Limited, because you all know that Bectors Food Specialities IPO opened on December 15th and closed on December 17th, that is yesterday. And it was, of course, oversubscribed. The total size of the IPO was about expected to be 540 crore. And the purpose of the IPO was a disinvestment of stake by the private equity firms and also the expansion of their manufacturing facilities. But a significant part is the offer of sale. Let us understand, get some idea about this company before we get into the financial statement. BFSL, incorporated in 1995, is one of the leading companies in the premium bakery segment and premium and mid-premium biscuits. But its majority of its operation, or significant part of its operations are in the North India. The company's product portfolio mainly consists of two categories of products, that is biscuits and bakery products. All of its products are manufactured in-house in 5 different cities in Maharashtra, Karnataka, UP, Himachal Pradesh and Punjab. But we can see that there's a very small presence in the southern part of the country, and has a very strong distribution network of 154 super stockists, 654 distributors, 458,000 retail outlets, and around 3,500 preferred outlets, depending on the nature of the contract and agreements. It sells its products in most of the states, though the presence is on the north, and also exports its products under its own name and also third-party labels to about 64 countries. So significant presence in the outside or export market also. The firm supplies buns to QSR like McDonald's, KFC's, Burger King. And we know that recently Burger King India also went for an IPO, and the market reacted very positively, and response was also good. And for this company also, the response has been quite good. There was an oversubscription. But now let us see the financial statements of this company and understand and undertake some bit of basic financial statements analysis. So because it is not listed, first time is going for IPO. So I picked up this data from the Financial Express. So we can see that the shareholders fund has increased. The non-current liabilities have reduced. The current liabilities have come down, and the total non-current assets are more or less in the same level for the last 2 years. But in order to make sense out of this balance sheet, let us first convert this balance sheet into a condensed balance sheet by keeping the relevant items which will be more useful for our discussion. So equity, non-current liabilities, current liabilities, current assets and non-current assets. So we can see that equity has gone up from 2,838 million to 3,071 million. And the increase is due to their reserves going up because the capital is constant, and the increase in the reserves is due to the increase in the profit and loss account balance. That means the operations for the business. Whereas the non-current liabilities and the current liabilities has come down during this period. But to make even this condensed balance sheet more meaningful, let us get in combine the what you call the common size, convert this into a common size balance sheet and get a feel of the comparison. We can see that equity accounts for 56% of the total sources. Non-current liabilities account for 21% of the total assets, and current liabilities 24% of the total sources. We can get a feel of this by observing this pie chart, that how is the company financing its business. Around 69% of the total assets are in non-current assets and 31% is current assets, whereas equity is accounting for 56%, and if I combine the non-current liabilities, so 77% of the total sources of the business are from the non-current sources, whereas the non-current assets are 69%. So therefore, the working capital is positive, where the current assets are more than the current liabilities. So from the balance sheet, we are able to see that the business is funded by the equity, and over a period of time, the non-current liabilities or liabilities in general have been decreasing, and increase in the equity is due to the profit. So let us see the income statement of the company. The income statement, the sales, it's interesting to observe this. The company is making profit, of course, 362 million and 239 million. But observe the sales have come down. The PBIT has come down. PBT has come down. PAT has come down. So in order to understand why PBIT has come down, it is necessary to convert this income statement and do a common size income statement and see the changes in the income statement. We can see that the significant part of the revenue is going towards the recovery of the raw material cost. Obvious, because this is a bakery product. And the power consumption is about 5%. Employee cost has increased from 14 to 16%. The manufacturing expenses, almost all the expenses have gone up. So no wonder the EBITDA, EBIT, and PBT as a percentage of the revenue has come down. So the decrease in the sales, increase in the expenses has led to the decrease in the profit after tax. But still the company is a profit-making company. Is the company able to convert the profit into cash? Can be the next question. For that, let us see the cash flow statement. We're able to see that both the years, the cash from operation is positive. That means the business is generating cash from its operating activities, which is a good sign. And now with the new IPO, with the more funds, they're planning to increase their operations. So therefore, it's expected that CFO will keep on rising. So it is not just CFO is positive, but CFO is also increasing. And more importantly, or equally important, is the CFI, the cash from investment activities, is negative. That means the business is creating more assets, which is a sign of growth. So they're creating more assets, and increase in the creation of assets will lead to the creation of profits for the future. And financing, the company has been repaying the loans, as we have seen, and also declaring dividends. So overall, we are able to see that though the profits in absolute number has come down, the business is growing, is generating cash from operations, and the business is investing money in the creation of asset. Now, with this background of common size balance sheet, common size income statement, and cash flow statement, let us pick up some important and relevant ratios and observe what is the behavior of some important items on the balance sheet. So one of the important items we often pick up is the let us say working capital. The working capital in both the years positive. We already saw that. The reason for the positive working capital is the current assets are greater than the current liabilities, that means the liquidity position of the company is reasonably okay. When I say reasonable, because the current ratio is around 1.5. But in order to understand whether this is liquid or not, we can see the composition of the current assets. Let us see what is the composition of current assets of this company. The current assets, you can see that the debtors are coming down. That means they are able to collect money from the business. Very small amount of the debtors are more than 6 months old, which is good. The short-term loans they might have given to their maybe employees or some sister concern, which has also come down. So therefore, the current asset is not a big amount of cash sitting idle there. So significant part of the current assets are inventories and the debtors. In the same way, let us also see the current liabilities. The current liabilities have come down from 1,300 million to 1,200 million, but the big chunk of the current liabilities are trade payables, maybe the suppliers' money. It's good that they don't have short-term loans or bank overdraft, don't have much from advances from the customer. So, in order to examine the current ratio and working capital, it is always better to see the composition of the current assets, because all current assets are not equally liquid, and also see the composition of current liabilities, because some of them may be interest-bearing liabilities, which is not the case in Bectors. Debt equity ratio is far below 0.1. Is it because the equity has been rising, and now the debt equity may further fall because of the new issue of share. So from the debt equity point of view, it is definitely, if you use that as a solvency reflection, so the ability to meet long-term obligations seems to be quite reasonable. But of course, we have to compare this with its competitors, which we'll do at a later part of this presentation. We already observed this, that a significant part of the total assets are financed by the long-term sources, and significant part of the long-term sources is the reserves and capital. So the business is being funded not by the loans or liabilities, but is being funded by equity. We can see that equity is contributing 56% of the total assets, and significant part of the equity, we can observe that is the reserves, right? So total equity is 3,000 crore, capital is only 3,000 million, and capital is only 573. The balance is the accumulated profit. Debt is accounting for only 21%. So no doubt, because of this, their interest coverage, which is a reflection of the ability to pay or meet the interest coverage ratio, shows the relationship between PBIT, that is profit before interest. So PBIT is around 5.5 times of the interest, and because the debt equity is low, because the PBIT is positive, So interest coverage has to be higher. But what is the ICR is falling. The fall is because of the fall in the PBIT. And the fall in PBIT is because of a small fall in the sales. So the company has to improve the operating efficiency. Overall return on equity, that is the ROE, PAT by equity, is positive, but we can see that the PAT by equity has come down because the equity has been going up and the PAT has. So there is a need for us to examine a bit more detail the changes of the factors affecting the ROE of Bectors, because this is in a very competitive market. This is not a niche product that everyone will just buy Bectors. So they have to manage the income statement, they have to manage their operations, so therefore they can improve the bottom line of the company. But in order to understand what is driving, what are the drivers of ROE, it'll be good if we can do a DuPont analysis of the Bectors. And we saw that the debt equity ratio of Bectors is around 7.8%, and the DuPont analysis says that ROE is a function of profitability, efficiency, and the leverage. Operations are reflected by PAT by sales. Efficiency is reflected by how efficiently you are using your assets, sales by TA, and the leverage is reflected by TA by equity. But all these ratios will be meaningful if you only undertake what you call an inter-company or intra-company. In this case, because the data is available for 2 years, we did it only for 1 year. So PAT by sales is only 3.4%. So the margins available for this business are not very high. So the only way they can actually make profit is by cutting down the cost or increasing the price. But because they're operating in not a very easy market, playing with the price is also not easy, unless they really have a premium product, position is as a premium. And on one hand, they want to expand the business. If you want to expand business, more retail sales, price cutting, price rising will not happen as a strategy. So therefore, efficiency in the operation is very, very important. So let us understand this PAT by sales. We know that the PAT by sales depends on the tax effects or interest effect and OPEX effect. The tax effect is the impact of the tax on the bottom line, which is more statutory, and we know that the taxes, unless you do some amount of tax planning, the role of the contribution of tax effect on the ROI is not much, unless you are in a business where you get some tax benefits. Interest effect, yes, this is possible to be minimized or reduced, but the company is already having a very low debt equity ratio. So the scope here is also not much, but whatever small amount of debt is there, if they can repay because of the money they're raising through IPO, then the interest effect may come down. If interest effect comes down, then the PAT by sales may go up, and accordingly ROE may go up. But the critical part, according to in our understanding, is managing PBIT by sales, which is operation effect. What is this PBIT by sales? We already saw that. A significant part of the PBIT by sales, that is expenses, are 95%. And out of this 95%, the cost of material, cost of raw material is 54% of the total sales. So is it the case with all the players in the industry? That is important to observe. Employee cost is accounting for 15% of the sales. The sales and distribution is 8%. Maybe this may go up if the company is planning to expand its business. So for Bectors, I think this particular portion of operating efficiency will hold key in the future to improve the return on equity. Besides that, they have been already managing their assets reasonably well. They don't have too much of current assets in the form of debtors or stock. So this can be managing the sales to improving the sales to current ratio may happen not by reducing the current assets, but by improving the sales. And sales can improve maybe through pricing strategies, maybe by giving some discounts, or maybe by increasing more operating outlets. So therefore, even here, the impact of the operations. So overall, for a company like Bectors, I think the improving the operations will be playing a key role in improving the bottom line of the company. But as of now, the response from the shareholders or the market has been really good, and hope that money that the shareholders pump in here, about 50 crore, will be used to improve the operating efficiency. But before we close the presentation, let us observe the competitors. The comparison, this I picked up from the value research online. We can see, let us pick up the return on equity, because that's where we started. You can see that the return on equity of Britannia is 32%. Return on equity for ITC, which is of course not just the food, is about 25%. Okay, so DFM Foods is 18%. So therefore, I think the Bectors have to improve the return on equity. And whereas on other counts, let us say PBT margins, it is not just the leverage effect which is killing or reducing the ROE, but the PBIT is also on a lower side if you compare with the bigger players, if you compare with the leaders of that particular industry. Price to book ratio, as per the price of the quoted price in the Britannia, as usual, as expected, is 33 times the book value. The price to earning ratio is 50 times of the earning, whereas Bectors is also 55. Then all the more reason for Bectors, in order to satisfy the shareholders, to improve the earnings. So we have to keep a watch on Bectors' performance. It is not some niche product. It's a very, very competitive market. So they have to maintain the relationship with the existing customers. Maybe they have to make an effort to either increase the presence outside the country or penetrate the southern market or eastern market, because a bigger chunk of the business is in the north only. For example, Britannia is spreading all over the country. So overall, we saw that the performance of Bector can be improved by managing the operating efficiency of the company. In the process, we actually saw all the components of FSA. We wanted to understand conversion of a balance sheet into the condensed balance sheet, common size balance sheet, and the income statement, the comparative over a period of time, and the common size. We also saw the cash flows. So therefore, in order to undertake FSA of any company, it is necessary to understand the interrelationship between the financial statements, observe the change over a period of time. That means undertake an intra-company analysis over a period of time. And most important is to undertake an intercompany analysis to come to some conclusion about the financial position of the company. But as of now, the market is quite bullish about this, and let us keep a watch on Bectors Food Specialities. If we can't buy the shares of Bectors, let us buy the biscuits of Bector. Thank you very much.